Let me ask you something. If I told you that owning more investments could actually make you worse off, would you believe me? Because here's what I keep saying. Investors who buy ETF after ETF, stock after stock, convinced they're building something strong when really they're just building something complicated. And complicated portfolios have a nasty habit of underperforming simple ones. Today we're going to settle this once and for all. How many ETFs do you actually need? What does the research say? And what are the specific mistakes that most retail investors make without even realizing it? Stick around because by the end of this video, you'll know exactly how to structure your ETF portfolio, and more importantly, you'll know what to stop doing. Before we get into the numbers, let me explain why this question is so much more important than it sounds. When most people start investing, they go one of two ways. The first type buys a single ETF, maybe an S&P 500 fund, and calls it a day. Simple, low cost, easy to manage. Good instinct, but possibly leaving some diversification on the table depending on their goals. The second type does what I'd call ETF collecting. They see a video about tech ETFs, they buy one. They read an article about dividend investing, they buy another. They hear about emerging markets, international exposure, small cap value, clean energy, cybersecurity, and on and on. And before long, they've got 15, 20, 25 ETFs spread across multiple brokerage accounts. And they genuinely have no idea what they own anymore. That second group is who this video is really for. Here's the thing. There's a concept in investing called diversification. It's a term coined by the legendary fund manager, Peter Lynch, and it describes the phenomenon where adding more positions actually hurts your portfolio rather than helping it. You think you're diversifying, you're actually just diluting your best ideas, creating hidden overlaps and making your portfolio nearly impossible to manage. And the data backs this up. Research consistently shows that the marginal benefit of adding more diversification flattens out pretty quickly. After a certain point, you're getting almost no additional risk reduction, but you are adding cost, complexity, and confusion. So the question isn't, how many ETFs can I own? The question is, how many ETFs do I need to accomplish my actual goals? Those are very different questions. Let's talk about what diversification is actually supposed to accomplish, because I think a lot of people have a fuzzy understanding of this. The whole point of diversification is to reduce what's called unsystematic risk. That's the risk specific to any one company or sector. If you only own one stock and it goes bankrupt, you lose everything. If you own 500 stocks and one goes to zero, you barely feel it. That's diversification working exactly as advertised. But here's where it gets interesting. Research has shown for decades that you don't need thousands of stocks to eliminate most of that company-specific risk. Studies going back to the 1980s, including foundational work by Mayer Statman, found that the vast majority of diversification benefits kick in well before you hit 50 stocks. After that, you're running a diminishing returns game. Now, a single broad market ETF might hold 500, 1,000, or 3,000 stocks in it. So when you buy one quality broad market ETF, you've already knocked out most of the unsystematic risk that diversification is designed to address. You've already done the heavy lifting. What diversification cannot do, and this is important, is eliminate systematic risk. That's market-wide risk. When the whole company or economy tanks in a recession, almost everything goes down together. No amount of ETF accumulation protects you from that. The only real tool against systematic risk is asset allocation, specifically the balance between stocks, bonds, real estate, and other asset classes that don't always move in the same direction. This is the insight that changes how you should think about building an ETF portfolio. You're not collecting ETFs to reduce risk. You're selecting a small number of asset classes to balance risk and reward over time. Those are two completely different mindsets. Okay, so now let's get practical. Based on the research and the underlying logic of diversification, I want to walk you through what I think of as 3 legitimate portfolio tiers. None of these are inherently better than the others. It depends on your goals, your time horizon, and honestly how much complexity you're willing to live with. This is simpler than most people think is acceptable, and it's more powerful than most people give it credit for as well. A single total market ETF. Something like a US total stock market fund gives you exposure to thousands of domestic companies across every sector and every market and of cap size. Large cap, mid cap, small cap, growth stocks, value stocks, all in one fund, one expense ratio, one line on your brokerage statement. If you want international exposure alongside that, which most long-term investors probably should have, you add one global ex-US fund. Now you own two ETFs, and you're invested in effectively the entire world's equity market. Is this exciting? Absolutely not. Is it sophisticated sounding? Not really. But does it work? The data says yes, emphatically. Most actively managed funds and most complicated multi-ETF portfolios do not outperform a simple two-fund approach over a long time horizon when you account for fees, taxes, and behavioral errors. This portfolio is ideal for somebody who wants to build wealth steadily, doesn't want to think about investing constantly, and understands that simplicity is a feature, not a flaw. This is where most investors who want some control over their allocation should land. You've got a core broad market exposure, and you're layering in specific asset classes with purpose. A reasonable example might look like this. A US total stock market or S&P 500 ETF as your domestic equity core, an international developed markets ETF for exposure to places like Europe, Japan, Australia, an emerging markets ETF if you want higher growth, higher volatility exposure to countries like India, Brazil, and South Korea, and possibly a real estate ETF or a REIT if you want something that's income producing, inflation sensitive exposure without owning physical property. That's 4 ETFs. Every single one has a clear job. There's minimal overlap between them. You can look at your portfolio on any given day and understand exactly what you own and why. This structure gives you meaningful control over your geographic and asset class allocation without crossing into the danger zone of overcomplexity. The key word in that list is purpose. Every ETF has to earn its spot. If you can't explain in one sentence what job an ETF is doing in your portfolio, it probably shouldn't be there. I want to be careful here though, because this tier is only appropriate for a very small subset of investors. Some people genuinely want fine-grained control over factor exposure. Things like tilting towards small cap value stocks, which have historically produced higher long-term returns at the cost of higher short-term volatility. Others want specific sector bets, like semiconductors or healthcare, because they've done real research and have conviction. Others are managing large portfolios where tax efficiency across multiple accounts justifies more complexity. For those investors, a large number of ETFs can be justified. But even here, discipline is everything. Charles Schwab has noted that once you're managing 13 or more equity ETFs, it becomes genuinely difficult to track your total stock allocation without serious spreadsheet work. The bid-ask spread costs start to add up with every rebalancing trade and the behavioral risk. Making emotional decisions across dozens of positions during a volatile market goes up significantly. If you're in this tier, you need to be honest with yourself. Are you adding funds because each one has a specific strategic purpose, or are you doing it because it feels like you're doing something sophisticated? There's a big difference there. Here's one of the most common and most costly mistakes I see, and it's something that's genuinely easy to miss. When you own multiple ETFs that share a lot of the same underlying holdings, you're not getting additional diversification, you're just getting concentration in disguise. Think about this. A US total stock market ETF and an S&P 500 ETF overlap by roughly 80% or more. Owning both doesn't meaningfully change your portfolio, it just adds another fund to track, another line item at tax time, and potentially another expense ratio eating at your returns. The same thing happens when people own multiple sector ETFs that all happen to be heavily weighted towards a handful of mega cap tech companies. You think you're diversified across 4 different funds. What you've actually done is just concentrated in Apple, Microsoft, and Nvidia from 4 different angles. Before you add any ETF to your portfolio, ask yourself, what does this fund hold that I do not already own? If the answer is mostly the same stuff, you probably don't need it. There are free tools online that let you look up overlap between any 2 ETFs, and I think you should use them. It takes 5 minutes and can save you months or even years of unnecessary complexity. I want to spend a minute on thematic ETFs, specifically because these are marketed brilliantly and they exploit something very human. The desire to invest in something that feels exciting and forward looking, clean energy, AI, genomics, space exploration, cybersecurity, metaverse, cannabis. These funds aren't inherently bad. Some of them represent genuinely important long term trends. But here's the problem with most of them: they tend to launch after a theme has already gotten hot, which means the hype is already priced in. And they often hold a relatively small number of companies with heavy concentration in the same handful of names. The other issue is that thematic ETFs often carry higher expense ratios than broad market funds. When you've already uh, when you're already fighting an uphill battle of picking the right theme at the right time, paying an extra 0.5% or even 0.75% per year in fees makes the battle even harder. If you genuinely believe in long-term theme and want exposure to it, that's a personal decision. But treat it like you would a concentrated stock bet. Size it accordingly, and don't let it represent more of your portfolio than you'd be comfortable losing 50% of. Because with niche thematic ETFs, that kind of drawdown isn't theoretical. It has happened repeatedly across multiple market cycles. So, how many ETFs should you actually own? Here's my honest answer. For the overwhelming majority of investors, the right number is somewhere between 2 and 6. 2 funds can build you a globally diversified equity portfolio. 3 or 4 can add bonds or real estate. 5 or 6 can give you fine-grained control over geographical factor exposure without tripping into confusion. Anything beyond that requires genuine justification, not vibes, not YouTube, not Reddit, not FOMO, actual strategic reasoning. And here's the thing that I think gets overlooked in every version of this conversation: the number of ETFs you own matters a lot less than the behavior you bring to your portfolio. The investors who build real wealth over decades aren't the ones with the most sophisticated 20 fund portfolios. They're the ones who built a reasonable plan, kept costs low, and this is the big one, didn't panic sell during every market correction. Simplicity makes that last part easier. When your portfolio fits on a note card, you understand it. When you understand it, you're less likely to make impulsive decisions when things get scary. That behavioral advantage is worth more than any clever ETF allocation you could engineer. So go open your brokerage account right now and count how many ETFs you actually own. If the answer is more than 6, I want you to do 2 things. First, check the overlap between your funds using a free ETF comparison tool. Second, ask yourself honestly: does every single fund in this portfolio have a specific irreplaceable job? Or did some of them just drift in because they seemed interesting at the time? You might find that a little simplification goes a long way. If you found this helpful, hit subscribe. I put out videos on investing, portfolio construction, and financial decision making every week, all designed to cut through the noise and give you something actually actionable. And if you got a specific question about ETF selection or portfolio structure, drop it in the comments. I read them all, and I use viewer questions to plan future videos all the time. So thanks for watching. I'll see you in the next one. Stay safe in the markets.